Welcome to the Generational Investors Podcast, where we explore the timeless principles of building lasting wealth. I'm your host, John Woodard III, accompanied here by my father and president of our sponsor, Woodard and Company, John Woodard. And this week's edition of the podcast, we will be discussing what's really been going on in the markets in 2025, what's coming up in this year. And I must say there's been quite a lot going on, and so we have a lot to get into. But just to do a quick little breakdown, 2025 ended the year solid with positive earnings across the board for only one sector being in the negative, that being real estate sector. Everything else turned out to be positive, with communication services and information technology sectors coming out in the green for being the top two performers. The Mag 7 turned out being a leader for two of them, NVIDIA and Google. Both were outperformers of the S&P, which the S&P finished off about 16 to 17%, and the NASDAQ was up around 20. The internationals were one of the best performers, actually up about 27, 28%. Small caps lagged throughout most of the year, but this year actually they're making their return, and that's due to a few different factors, which we will hop into and mention. But overall, it was a good year. One of the main reasons was some people coined it the term of AI CapEx spending. So that is capital expenditures. That's when a company invests money back into their own firm and use that cash flows instead of just sending it to distributions to shareholders in form of dividends or anything of that sort. So anyways, that's strong earnings growth. The S&P had about 14% earnings growth. That's one of the big things that propels markets. That, along with the inflation tampering down and just trade deals coming in, deregulation, all those things help secure a good spot for markets in the past year. But just going forward, I'd like to ask, what do you think is going in for 2026? Anything else to add on 2025?
First, let me add to 2025. If you look at foreign markets, virtually all of the performance comes from the weakness in the dollar and the strength of the foreign currencies. It's not like they've had earnings increases or solid economic growth in Europe or in China or other places. It's almost all dollar weakness, and so when you're denominated in the currency of the euro, if you will, the renminbi or whatever currency you're denominated in, if the dollar's weak and the currencies go up, you make money in the stocks, even though their stock market really itself did not perform that well. And also, if you look at the performance last year, small caps did well, as you indicated, and the Mag 7 or the technology. In a declining interest rate environment, and that's what we saw last year, those are the two stock areas that usually outperform. This year, I think the 10 years in a reasonable range. I think we could see anywhere from 3.5% to 4.5%. The U.S. Treasury, and if we fall, and I know the current administration would like to see a decline in rates to help home buyers and so forth. So in that environment, typically small caps and the technology stocks tend to do well. So,
Quick question to interrupt you there. When you mentioned the dollar's valuation is declining, what typically causes that in a given environment?
The government policies, they try to push the dollar down. A weaker dollar increases our exports, and if you look at our trade deficit, it is shrinking probably exponentially more than it has in 25 years. But the dollar weakness is the administration wants a weaker dollar, and so they have a number of policies they'll implement to shrink the dollar, and it's great for exports, and it's good for the U.S. economy, oddly enough. But the thing is, the more you build a solid foundation for the U.S. economy, at some point the dollar will strengthen of its own, and you'll see printing more money is probably the biggest thing. You print a lot of money, you got a weaker dollar, but also printing more money, you're going to have more inflation. Hopefully the tariffs will offset some of this and mitigate that. as a revenue comes in. But when you have, let's say you're going to build up the defense spending, you probably have to print dollars to do that, or whatever. So that's inflationary. That shrinks the dollar value, so forth. There's lots of factors.
Makes sense. That's the one thing to go back to international, as though that showed some increase in just their GDPs and everything, would have been European defense spending has had a little bit of a rise just because Trump last year called out for that. But apart from that, I guess there really wasn't too much.
No, their policies.
The board.
Their policies are more of socialism than capitalism, and they do not. They've also been able to spend more on social programs than the U.S. because we've paid for their defense. Interestingly, now they can't spend as much, and industry actually has to come back a little. As far as is going forward for 2026, probably a little bit lower interest rates. You got the big beautiful build. Tax money's coming back in. People will be spending their own money, and that's good for the economy because corporate earnings. There's the biggest correlation statistically to market performance is corporate earnings growth. And we're looking for anywhere from 12 to 15% this year. So that would suggest we'd get another 17, 18% performance if it's like last year for the S&P. So you've got a circumstance where I think that maybe one of the primary drivers is going to be deregulation. The deregulation has been just exponential. And you could see it if you look back at the banking industry in 1980 when Reagan came in and the deregulation there, getting rid of Glass-Steagall Act and so many other things. Glass-Steagall separated brokerage and banking, and the banks couldn't get into the investment industry. And that came about because in the 1930s, the banks were involved with the stock market, and things didn't go too well, if you recall, in 1929 and so forth. So when you have that environment with deregulation, you could see the banks just really did incredibly well in the 80s and the 90s up into the late 90s. And Lord knows for the last since 2008, boy, they've done horrible up until the last year or so. So you've got to, historically, when the banks do good, everybody does good. And it comes through because there's dollar creation effect, 8 for 1. I won't get into that, but it's like if they lend $1, it multiplies itself.
Yeah,
because
yeah.
So indeed, deregulation is really big, and you hear Trump saying something about 10% for credit cards and everything, but the banks have been given with this deregulation, they've had so much benefit, and you can look at their stocks. They've done exponential growth in last year, just really good. With deregulation, it's been really good for the banks and bank earnings, and I guess he's wanted to try to stimulate the economy more, giving people lower interest to pay back and maybe spend a little more on their credit card. So we're looking for in excess, hopefully, of 15%. You never know. There could be a black swan out there, an event that could be extremely negative for the markets.
So yeah, describe just a little bit the black swan event for those who wouldn't know what a black swan is.
Swans are white, and if a black swan appears, it's unexpected, very unusual, unheard of. The tariff panic last year wasn't a good example of a black swan event. Trump announced his tariff. What is it? Freedom Day? What was that? Liberation Day. Yeah. And all of a sudden the markets just crater. Yeah, we're down 25%. It surprised a lot of people. And the financial crisis in 2008,
you think,
boom,
do you think Black Monday in '87 would have been?
Yeah, Black Monday, yeah. Or the tech bust in 2000 and so forth. It's kind of a sudden event, and all of a sudden, and what happens is people go seek liquidity, and when you get one of these events in 2008, what actually drove us into that was Lehman Brothers collapse, in September, I think September 21st, 22nd, 2008, Lehman Brothers did commercial paper. Commercial paper is the backing for certificates of deposit in money markets. And so in that scenario, this was the safest of, Lehman Brothers, with the banking collapse, they had been putting money in real estate and stuff that should not have been being used. And so,
Why is that? Just why would they putting
real estate's a long-term investment typically, and
these things are all short-term.
exactly.
We saw liquid.
We saw Wachovia's money market. What's it called? I can't remember the name of their mutual funds. It escapes me, but they had like 70 to 80% of the backing of their money market. Now this is daily liquidity, it's worth $1 a day every day. 70 to 80% of their money market was in real estate investment. And
that's criminal.
There was a time when you wouldn't expect virtually any of it to be in there, because real estate, you think of it as 15 or 30 year paper, right? Mortgages are 15 and 30 years.
Yeah.
And so what we saw was a liquidity crisis event. And if you ever, for your portfolio, if you ever want to say, hey, this is the moment when you go for liquidity, you're not going to sell your house quick. You're probably not going to sell your car quick. You're probably not, but you can sell your stocks.
Yeah.
And bang, first thing you do, you cash out your money market. We had some money market failures in 2008. And so in that event, when everybody goes and it's like when the theater is on fire and everybody heads for the exit at one instance, the exit gets kind of crowded. And so you have a sharp contraction of just like we had earlier this year with the tariff panic, and the markets went down with 25%. So a black swan event is an event, usually it's going to be a liquidity event, and it causes a sudden massive contraction where everybody is selling it just as fast as they can. In '08, we saw AAA, General Electric bonds, GE, Bedrock Corporation. We saw their AAA bonds crater down as much as 20% in a day or two or three. And
that's something for fixed income of that sort. You would never.
It shouldn't have happened. But what happened in addition there, what exacerbated that decline, you have, and this has happened before in the 70s and the 80s, you had China, you had Russia, you had our enemies get in, and they'll do it again. In that kind of event, they want to see if they can't destroy the economy. And so they actually got in there and they were selling, shorting, they were just dumping. They were literally trying to destroy. They hate capitalism as communists. They were trying to destroy capital markets, and but we have a Federal Reserve, and the Fed went in and were buying bonds. They were doing all kinds of stuff, and they were supporting it. Not only did they support our markets, but they went and they supported foreign markets. They went in and they bought Euro bonds. They did all kinds of stuff. They had a lot of activities. And these activities, finally stabilized it. But like in 1987, it's like a rocking tub of sloshing over. They go in and they'd buy like crazy to stabilize, and then they'd have to get liquidity, and then they'd sell into it, and so you'd have big up days, big down days, big up down, and finally they stabilized the ship, and. But you have a loss of confidence by investors, and typically it takes a while. But by March of 2009, for example, we had bottomed out, and confidence comes in, and people start buying again. I'm sorry, I really get into the black swan event. So
they're fascinating. It's something. Hopefully this year, nothing like that will happen. But you all know, with midterms coming up, it could be something, and then also just the hype behind AI. Could really cause some event like that, just a panic if numbers start coming out from NVIDIA that suddenly the chips are not doing what they should be for revenues wise or whatnot, which doesn't seem possible, but that's exactly what might create something of sort.
We've raised cash a few times, very few times over the years to any appreciable extent, and it was in liquidity events like this. And if you're ever wanting to say, hey, I want to panic here, markets will be fine long term. But these liquidity events are the defining moments where you're gonna find people go in. They want cash. They want to hold, put the money in their hand. And let me say this also in 2008, The Congress made it, and a lot of people aren't aware. So because of that event, in the following, I think Dodd-Frank, some of the other stuff, they made it so they can literally stop people from pulling all their money out of money markets. So it's a
But it's
stabilization
only-
factor.
There's one money market that does not have that permission.
That's right.
correct?
The U.S. Treasury money market. They can't stop that one. You got to always have liquidity in U.S. Treasuries, and that's why we use the Treasury money market.
makes sense.
But the typical money market, they have they put it in so they could actually, it may be like in It's a Wonderful Life with Jimmy Stewart when everybody was going to the bank to try to get their money out, and Thelma or something just said, "Hey, I'll settle for $10." I think that's what that's the intent is to try to stop that, but. What do you want money market for? Liquidity. If you want your money, you want it in your hand, and to you, that's in your hands. So anyway,
Well, good outlook, good overall. Sectors wise, what we're looking at this year, I mean, I'll start off first a little bit, and just as always, as previous years with AI still being as is coined the fourth industrial revolution, the information technology sector should be one of the better ones this year, along with communication services. But that one in itself last year was a top performer just due to Google being up about 60%, and that's Google in itself. I mean, we could have a whole field day just talking about all the individual stocks, but that could be for a different episode. And of course, we'll not be able to have any recommendations for specific stocks, but any other sectors wise, I know we listened to Denise Chisholm from Fidelity, and then Ed Yardeni from Yardeni Research, also a former economist with E.F. Hutton. Those are two of our favorite economists to listen to, and they're both saying along the lines of what we've mentioned, as well as biotechnology. And I think with the weight loss drugs, the healthcare sector might be something to look out for. But then again,
also Trump said you're going to spend $1.5 trillion on defense. So
that's true.
Industrials. So yeah, and defense stocks are up. We think a number of stocks will do well. I don't want to do that. In any event, we feel like interest rates with announcement that we're going to buy $200 million in mortgage-backed securities, that they're trying to get rates down to with lending in any number of areas. And we're going to probably have a new Fed chairman with the intent
in May.
In May, yeah. And once again, so much of this debt was run up when we were doing quantitative easing, and as a consequence, there was interest rates were low. Now our interest payments are like $1 trillion a year or something. It's crazy. So there's a lot of reasons why we would want interest rates to come down. Well, when that happens, typically small caps and technology stocks. One's an asset class, one's a sector, but those are the sector and asset class that typically do well in that environment. Yeah.
Yes, and that's something good. And for future episodes, we'll also just do more in depth on historical events such as the crash of 2008, Black Monday in 87, different things, because there's a saying that goes that history doesn't repeat itself, but typically it has a ring to it. And so essentially these historical events, we can time things and look at what all is going on, but at the end of the day, there's always something new to factor in, and all these different situations. There just is always so many components to put into it. But I guess before we finish off here with the episode here, do you have any other tidbits and things you'd like to mention about the given year? I mean, metals are looking like they're hitting all-time highs once again today as this is being recorded. Silver's at $95 an ounce, and it's almost twice what a barrel of oil is. I mean, gold is hitting all-time highs. Anything you think you'd mention it?
I'd love to see a resolution on tariffs from the Supreme Court, and so we could move forward from that. I would love to see stabilization and trade and so forth. Our trade deficit is really looking good. I think oil prices could move even a little bit lower. I could see us, paying $1.80, $2 a gallon at the tank, and oil is in everything. It's in just about everything we use. Our roads, everything. Consequently, I think when you take the big beautiful bill, the tax cuts and the money going back to people. You take the low oil prices, you take the tariff income, and you take a lot of these factors. This could really be we saw GDP growth in the fourth quarter of 2025 get up to the 5% range. Throughout most of 2010 to 2020, 2008 to 20. Anyway, we saw GDP growth at 1%. I mean, this could be a really good year.
One for greatness, wonderful.
Yes, sir.
Yeah. Well, so hopefully we'll look back at this video a year from now, and hopefully we'll be right on most everything.
Yeah.
And I think everyone else will be happy if we are.
Yeah, I agree. Yeah. I want it to be better than we're saying. Yeah, obviously.
Yes. So let's hope to be. But before we wrap up, each week I like to do a little segment called John's Weekly Pick, and that's something that is just something that I enjoy doing. A restaurant I like to go to, a new habit that I've formed, a book I've read, and it can range from an array of things. But there's something just to add a little personalization to touch here. And for this week, which is the first week, we're going to start off strong. And actually, you can help me out on this one a little bit. But my pick for this week is a restaurant located in Blowing Rock, North Carolina, called Gideon's Ridge Inn, or it's the restaurant Gideon's Ridge Inn. It has the best steaks in all of North Carolina, and honestly, up and down the East Coast, it might rival them. Specifically, they have the Wagyu strip loin. But anyways, it's located in this restaurant up about 2 minutes away from the Blowing Rock in Blowing Rock, North Carolina, that looks out over the Blue Ridge Mountains. And on TripAdvisor last year, it was rated number 2 in the country for fine dining and number 1 for most romantic restaurants. But it is a staple restaurant. It's one that if you ever have a date or out just on a weekend with friends, it is a place where I would almost make the destination just to go there.
And good luck getting a reservation. It's not easy. It's very difficult, but it's located. The restaurant is in an 1890s stone inn with the most beautiful view of the John River Valley. In the restaurant, you're looking out over the Johns River Valley and you're also looking over to Grandfather Mountain. It is it's like a world away, and it's not cheap, but it's wonderful. The big fireplace in the room when you walk in, and just it's a warm, friendly environment. Wonderful folks. Service is great. Atmosphere is just beautiful, and the views are incredible. And then on top of it, you get really, really fine meal. It's a lot of fun. John's hobby is cooking too, so he looks at it with a very critical eye when he goes places and eats, and we've been there a number of times. So.
Yes, we have. It's something fun. That's just to give a layout, just for when we mentioned future restaurants or anything. That there's 3 qualities to a restaurant that makes it good, and that's service, food, and atmosphere. And so, to me, I think the number 1 is for most of the time atmosphere, just because I could enjoy myself eating a Big Mac in the Grand Canyon. Even though Big Mac's really good, but instead of eating a A5 Wagyu fillet that's sitting in some rundown dump, but service is always crucial, just to make the meal flow like that. If it's a nice meal like that, and then atmosphere, food, service, it just comes together and make a good restaurant. And that is what Gideon's Ridge is. And luckily, there's a few other good restaurants in Blowing Rock that are around. But I'm just hoping Michelin, the tire company, but also the company that does restaurant reviews, they've now made it to North Carolina, South Carolina, and Alabama, I believe, and they've started giving out stars. So I'm just fingers crossed, hoping that they don't make it to Blowing Rock, because I already know the good restaurants there.
And so eating with John, I'll be doing a weight loss at some point. Recommendations, because I'm going to need it. Unfortunately, but it's a wonderful place, wonderful folks, and just a warm environment, beautiful.
As well. That rounds it up for today. As always, we like to finish with our motto here at Woodard & Company. Please remember to always buy quality and diversify. And that is all for this week. Thank you. The information provided in this podcast is for educational and informational purposes only and does not constitute investment advice, a recommendation to buy or sell securities, or an offer or solicitation of advisory services. It does not take into account your individual financial situation, objectives, or needs. Investments involves risks, including the potential loss of principal, and past performance is no guarantee of future results. Woodard & Company Asset Management Group is a registered investment advisor with the SEC. Please consult your financial advisor or tax professional before making any investment decisions.